Today, we will talk about how to create cash flow. Creating cash flow is a fundamental aspect of financial success, whether for individuals, businesses, or investors. Generating positive cash flow involves managing income and expenses strategically to ensure a surplus of cash. Let's explore various strategies and considerations on how to create and maintain cash flow. 1. Budgeting and expense management. Create a detailed budget. Creating a detailed budget involves not only listing income and expenditures, but also forecasting future cash flows. This comprehensive approach helps identify potential financial challenges and opportunities for savings. Utilizing budgeting tools and software can provide real-time insights into spending patterns, enabling better decision-making. Prioritize essential expenses. In addition to distinguishing between essential and discretionary expenses, a detailed budget allows for prioritization within essential categories. For instance, breaking down housing costs into mortgage payments, property taxes, and maintenance expenses provides a nuanced view, allowing for more strategic financial planning. Expense reduction strategies. Implementing expense reduction strategies requires a thorough examination of each spending category. Negotiating with service providers, optimizing subscription services, and embracing cost-cutting technologies are all essential components of an ongoing expense management strategy. 2. Increase income streams. Diversify income sources. Diversifying income sources goes beyond just having a primary job. It involves creating multiple streams of income that are resilient to economic shifts. This could include rental income from real estate investments, dividends from a diversified stock portfolio, or income from a side business. A diverse income portfolio acts as a financial safety net. Negotiate salary or rates. Negotiating salary or service rates is a skill that requires continuous refinement. This involves showcasing one's value to employers or clients and staying informed about industry standards. Developing negotiation skills can lead to not only immediate increases in income, but also long-term financial growth. Passive income opportunities. Exploring passive income opportunities requires understanding various investment vehicles. Real estate, for example, can provide rental income, while investments in dividend-paying stocks or bonds can generate regular passive income. Evaluating the risk-return profile of each opportunity is crucial for building a sustainable passive income stream. 3. Debt management. Prioritize high-interest debt. While paying off debt is a common financial goal, prioritizing high-interest debt is particularly crucial. By allocating more resources to paying off debts with higher interest rates, individuals can save on interest expenses and accelerate their journey to debt-free financial health. Refinance or consolidate debt. Refinancing or consolidating debt is a strategic move to optimize cash flow. By securing lower interest rates or combining multiple debts into a single, manageable payment, individuals can free up additional funds that can be redirected towards savings or investments. 4. Optimize accounts receivable. Effective invoicing is not just about sending bills on time, but also about clear communication. Clearly outlining payment terms, late fees, and accepted payment methods minimizes confusion and accelerates the accounts receivable process. Offering discounts for early payments is a proactive approach to managing accounts receivable. This not only incentivizes prompt payment, but also strengthens relationships with clients. Strategic use of early payment discounts can contribute to a more predictable cash flow. 5. Manage inventory efficiently. Just-in-time inventory. The just-in-time inventory management approach involves receiving goods only as they are needed in the production process. While it requires careful coordination, this strategy minimizes holding costs and reduces the risk of excess inventory, freeing up cash for other business needs. Regular inventory reviews. Regularly reviewing inventory levels is a dynamic process that involves assessing market demand and adjusting procurement accordingly. Liquidating slow-moving inventory can inject cash into the business, while optimizing stock levels prevents overcommitment of funds to storage. 6. Invest surplus cash. Investing surplus cash in short-term instruments, such as money market accounts, provides a balance between liquidity and returns. These investments ensure that cash is readily available while earning a higher interest rate compared to traditional savings accounts. 7. Emergency fund. An emergency fund is not only a financial buffer, but also a strategic asset for maintaining cash flow during unforeseen circumstances. Establishing and consistently contributing to an emergency fund ensures that unexpected expenses can be covered without disrupting ongoing financial commitments. 8. Insurance coverage. Insurance plays a critical role in mitigating risks that could impact cash flow. Adequate health insurance, property insurance, and liability coverage protect against unexpected expenses and potential disruptions to income. Regularly reviewing insurance coverage ensures it aligns with evolving financial needs. 9. Continuous learning. The financial landscape is dynamic and subject to constant change. Continuous learning involves staying informed about economic trends, market conditions, and regulatory developments. Embracing a mindset of lifelong learning empowers individuals to make informed financial decisions in an ever-evolving environment. Creating and maintaining positive cash flow is a multifaceted process that requires a holistic approach to financial management. By combining detailed budgeting, income diversification, strategic debt management, and continuous learning, individuals and businesses can build a robust financial foundation. This foundation not only facilitates day-to-day financial operations, but also positions them to seize opportunities and navigate challenges with resilience. Ultimately, the journey to sustained positive cash flow is a dynamic and ongoing process of refinement and adaptation. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.